Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at a dividend stock. This company has been around for a long time, but before I do look at the company, I would like you to like the videos, okay, genuinely, because it really helps a lot. Like when you give it the videos a like, obviously the YouTube algorithm then obviously recommends to other people that like to invest in the stock market, similar sort of companies, and inshallah we can reach out more people and we can grow the channel. And if you have any questions, as always, let me know. If you haven't subscribed to the channel, please do so. Okay, what I'm trying to do here is share my journey, okay, and I hope you're enjoying the content. And if you are, just let me know. And if there's anything, there's a couple of brothers that have actually requested me to look at a couple of videos. I definitely got the finally planned them, so I need to start recording those, and I'll let you know as soon as I finish those. So let's get started and look at this company. So the company we're talking about today is Cisco Systems. Cisco has been around for a very long time. Okay, this company sells internet protocol based on networking and other products related to communications and to information technology, and obviously when it comes to anything to do with networking, whether it's a network technologies like a switching, routing, wireless, data center products, whether it's included basically that software that we use to communicate, okay, it basically touches almost every single thing we do in our office. Even the phone that we use in our office is actually created by Cisco. And one interesting fact about this company is this, right? In the bubble, so the dot-com bubble in early 2000s, right, 2019, 99, 2000, whatever, right, what happened was this company was supposed to be the darling of the dot-com, and it was expected to be about like $1 trillion business by the end of that century, whatever. That was the plan. That's what everyone was talking about, and it was trading almost $80 per share. Guess what? It's never gone back to that situation. It's never gone back to that price. Genuinely, it has never ever since then, right? It's been trading below, way below than that, and right now it's half of what that was, $44 per share. So what I've always used this as an example, okay? So you have to be really careful about the high-tech companies that have no earnings or whatever, okay? Cisco was a great company. They had really good products, and the internet was the new thing, right? And everyone loved it and so on. So, but what it shows you is the fact that if you overpay for a stock, you might actually lose your money. Right now, if you invested in 2000 or 1999 this business, right now you'll still be down 50%. Okay, so you really have to be careful when it comes to valuations, and always do your research before you invest in a business. Okay, like none of us are, basically I'm not a financial advisor, so I'm just giving you some ideas, and then I'm going to show you what I'm doing, but that's about it. So then you're going to have to do your research. You can't blame anyone else but yourself if you end up doing something like this, because some idiot recommended, right, online and said, oh yeah, this is a great company, is going to go be $1 trillion business by the end of the century, blah blah blah. What happened? Look at it. Okay, so you really have to be careful. Right, let's have a look at the financials. The company, like I said, is obviously information technology. Current price $44 per share, market cap of $182 billion. P is just 15, price to sales is really low. EPS, basically it's growing from $2.85 to $3.55 next year. Current ratio is above 1. Beta is low. Operating margin is perfect. Sales is good. $51 billion. Total return in the last 10 years. And this is what I call a steady Eddie kind of company. Okay, 12.6% for last 10 years is really good for this type of business. Okay, net income, you look about $12 billion, profit margin 23, return on equity almost 30%, and they have $13.55 billion of free cash flow right now that they can reinvest in the business. And as you can see, it's been trending downwards in the last 365 days. Now, dividend yield, okay, we're looking about $1.52 for every share that you own. Okay, paid dividend yield $3.45%. Payout ratio just above 50%. 5-year growth rate just 10%, about 9%, and dividend safety of 91%. Now, when we look at the revenue from 2019 to right now, okay, we're looking about 51.9 to right now 51.58, because there was a dip obviously during COVID time. A lot of the offices closed, obviously, and for that reason, although we were using more data centers and that basically that side of the business was still growing, but when it comes to office products, people were basically working from home and recreating their offices at home rather than actually recreating a massive network. So probably that was one of the reasons. Okay, 49 and then 49.3, 49.8, and right now we're looking at $51.5 billion. So it is definitely heading in the right direction. In the last 2 years is actually increasing. The EBITDA is also actually gone down quite a bit, from 17 to 16 to 15 right now. So it's a very, you're going to have to be careful. If you invested in this business already, perfect, then you might just want a dollar cost average and leave it. If you start in a new position, you're going to have to do a little bit more digging and think about the next 5 to 10 years. Where are we going to be in terms of the business model? Okay, are we going to get rid of all the offices and everyone is want to go, is going to work from home? Are we just going to go back to the office full time? Okay, and we're going to definitely need those products. So you have to make that decision sooner or later. Okay, when it comes to free cash flow, we're looking about almost to $14.9 billion to right now about $13.5 billion. So it has declined a little bit as well. So you're going to have to be careful and do a little bit more research on the business and look at in the next 5 to 10 years the line of products that they have and basically what they're doing. A lot of them now, one of the things that I know they're doing right now is they're pushing more for the data center side of things, as well as the software as subscription, okay, the SaaS model, because what they've realized is that's where the model is, that's where the money is, okay, because if you think about it, software as a service, once you're in that environment, is very difficult to leave. Cisco, okay, we use it at work and it's very difficult to actually leave because all our servers and everything is actually them. They create those servers, they create those networks and so on that we use every single day. Our phones, like I said earlier, that is actually provided by them. So they have that stickability, if you like, or that white mode that you can't actually get rid of. But at the same time, you have to look at the future in the next 5 to 10 years. And Morningstar is actually saying about 18% discounted right now. Their price target is $54 per share. Simply Wall Street is actually saying $98 per share. And then Tip Ranks is saying about 52, which is very similar to what Morningstar is saying. Yahoo Finance 54, and next 5 years Yahoo Finance actually saying is about 7%, 6.5% growth next every single year for the next 5 years. It has I think this company should be a wide mode, because if you think about how long they've been around and the fact they actually kind of monopolized when it comes to the network side of things, although there are newer companies that are coming up, okay, no one is as big as this company. And when you look at the performance year to date, 30% down. And that's one of the reasons I want to share this with you, because when you look at these financials, basically the company that's like $182 billion company, okay, that has when you look at the things like the key ratios, for example, like if I quickly show you here, return on equity almost at 30%. Okay, and the net income of basically net margin, okay, we're looking at about 23%. So it is a great business. It's a good business. They have a great business model. And the other thing is the fact that the company is actually paying 3.45% of dividend, has a dividend yield. Okay, 91% is safe. They're not growing it really as fast as they should be, but when you look at their last 10 years, they've actually been growing this dividend. Payout is only 44%. So when you look at all of these things, and then last 5 years, okay, they've grown actually 9%. 10 years, almost at 28%. So since they started in 2010, you can see they have increased that dividend every single year for the last 10 years. So it's brilliant business, and you're getting, $1.52 for every share that you own. I think this is definitely, for me, something to look into in the long run, because it's that steady Eddie kind of company. They have a low beta in comparison to the rest of the sectors, okay? And as you can see, according to Simply Wall Street, they're actually saying it might be undervalued at the moment. Because when you look at the 5-year average of in terms of dividend yield, we used to be 2.97, but right now we're looking at about 3.45%. That's the dividend yield. And in terms of PE, we're looking at the average last 5 years will be 15.2, but right now 12.8. So again, when you look at all of these things and you factor these things, it's actually financially a great company, have been around for a long time. They have a business model that is still growing, and if they carry on investing in the research and development side of things, and they get share of the software as a service kind of side of things, I think this will be amazing. But I don't, obviously right now I don't own it, it's not in my portfolio, but hopefully in the long run I might actually look into it if I think this is gonna, because remember, if you don't own any technology companies and you're worried about how volatile these companies can be sometimes, it might be a good one to add because the beta is actually quite low. So that's one of the reasons I'm actually thinking about adding this company in my portfolio and possibly get rid of one of the high beta companies, because ideally it would be nicer to sleep well at night knowing that the companies that I own, if they go down today, will probably be about 0.5% or percent instead of like 3, 4 to 5% every single basically day. Anyway, that was just Cisco. I hope you enjoyed the video. If you have liked the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.